Welcome to Bar Chart series of webinars designed to educate you about a variety of market concepts, to inform you of the features and tools Bar Chart provides related to these concepts, and finally to give you some traders' insight to help you make a more informed investment decision. Today's subject, long put butterfly options strategy. Now, although there are many ways to play options from a neutral or a minimum price movement position, this advanced option strategy potentially can reap the largest rewards if, capital IF, the trader can actually accurately predict where the butterfly of price is going to land in a very specific time frame. Now, just like catching real butterflies, profits can be elusive. Well, hello everyone. My name is, there we go. My name is John Rowland, Bar Chart's head of trading education, and welcome and thank you for visiting today's session. And as I said before in the introduction, that today's option strategy is really for more the advanced options trader who has a strong conviction that price is not going to go anywhere soon, or they're convinced that price is going to remain in a very confined range between now and expiration. So stick around and hopefully I'll show you how to catch a long put butterfly. But until then, please welcome my partner and our moderator, Bar Charts Project Director, Gene Baker. Hello, Gene.
Hi, John. How are you doing today?
I'm doing fine. Yourself?
I'm great.
So let me ask you something. When you were a little girl, did you ever run around and try to catch butterflies?
I can tell you a story about that. I used to collect insects like caterpillars and do circuses with them. I don't think I ever had butterflies in my insect circus, but yeah.
A caterpillar circus, sort of like a flea market? No.
Yeah, make them walk the tightrope, but no
That's
butterflies.
Cool.
No butterflies. Sorry.
No butterflies. Well, if you remember, as a kid, though, think about this. Trying to catch butterflies, the bigger the net you had, the more chances of catching that butterfly, right?
So right. And if I let the caterpillars grow up, they would have turned into those butterflies. But, oh well.
There you go. Awesome. Excellent. All right. So let's get started then. All right. So remember, today our sessions are always for educational purposes only, and that decisions to buy, sell, or hold or trade any security involves risk and is best made on the advice of a qualified financial professional. Options trading is not for everyone. And under no circumstances shall we be liable for any loss or damage that you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on information that you receive through barchart.com and or our services. Okay. Let me get that out of the way. All right, long put butterfly strategy. Now, it's really just a combination of two put strategies, a bull put spread and a bear put spread. Now, this is where the trader is looking for three favorable conditions: a drop in volatility, a quickening of theta, in other words, time decay, and little price movement. Now, all of these will increase the chances of profitability, but price movement, actually the lack of, is paramount to success to this strategy. Now, the butterfly consists of a body, which is two short puts of the same strike, and two wings, a long put above our short puts and a long put below our short puts. Those are our wings. Now, maximum gain and loss, well, maximum gain can only be achieved if two events occur. First, price has to land on that middle strike, our body, and at expiration. Now, maximum loss is limited to the cost of the trade. And again, two events. Price will be outside of our outer strike wing and at expiration. Now, many times what will happen is as you set this trade up, losses can be substantially limited or less than the original maximum loss if the trader exits the position if price penetrates outside of our break-even values. And we'll look at that in a moment. So break-even happens if price falls on the value of our outer strikes plus or minus the premium we paid. So in other words, if I have the lower strike, we're going to add the premium price, and that'll be our break even. And if it's the upper strike, we're going to subtract the premium that we paid, and that will be the higher break even value. Now, the reality of this trade is that the loss and profits will be limited if price remains or is near or between our break-even value and our body up until expiration. Again, another way to achieve max would be at expiration. So as far as our Greeks are concerned, we're not going to go in a lot of details on this, but really we want to sort of set out to select a body where the strike price is close to current price or a price that we really believe is that price is going to gravitate around. And this will achieve that kind of that delta neutral. If we have a bias, let's say to the up or the downside, then choosing a strike body price that is slightly out of the money or slightly in the money, well, that will increase our profit, right? Think about this. What we're doing is we're predicting where that butterfly is going to land, what flower it's going to land, or what price is going to be landing. And if we can correctly predict that, we should be rewarded for that. Now, an increase in volatility usually has a slightly negative impact on this strategy, especially if the price is kind of vibrating back and forth around our body or back and forth between our break-even values. But if we're incorrect in our analysis and price starts to move towards our outer strikes, actually a rise in volatility, implied volatility, might actually help us out and maybe actually even lower our losses, maybe even get to maybe a small profitability. But we'll look at that example in a moment. Theta is our ally. Time decay is a positive. So, for this strategy, I really think you should think about looking at shorter dated options. Weekly options would be a great example. Monthly options are fine too, greater liquidity. But let's look at monthly options that are, let's say, inside of, 20 days towards expiration. And that's because you're going to get the theta is going to be really accelerated. It's going to become more exponential inside of that 20-day period. All right. Assignment and expiration risk. Well, our assignment risk is that we need to be very selective upon the stock selection that we're going to use to make sure that there isn't any events that could create price movement. And one event that we need to be aware of is ex-dividend dates. And we want to make sure there's no ex-dividend date between the time of the trade execution and our expiration. Now, here's a little trader's insight for you. So trading this particular option setup might be better suited for, let's say, indexes and ETFs. Now, that would help you avoid the dividend issue. But also, those securities tend to have a little bit more subdued volatility, and that will also help lower some price risk. In other words, like price gapping risk, which is more common with stocks. So just that's kind of food for thought for you. In terms of expiration concerns, it's very difficult for us to know going into expiration if we're going to be assigned, one of those short puts. Even if we're correct in picking the right price, we don't really know which ones might be assigned, or in other words, exercised. So the best practice really for this option strategy would be to exit the trade before expiration, before the end of the day of expiration. Or what we're going to look at is maybe even several days before expiration. Okay. All right, so that's kind of basically the basics behind the long butterfly strategy, long put butterfly strategy. So let's go to, whoops, excuse me, here we go. So underneath our main page, underneath options, here are our butterfly strategies, and there I've selected the long put butterfly strategy. Now, the first thing you need to know about this page is that the page is sorted by probability. The probability that the strategy is going to break even. But in other words, the probability that price will remain between our outer wings and our remain inside of our outer wings, less the premium that we're going to pay, the cost of that trade. So in other words, in between our break-even values. Now, how does probability pay out in this strategy? How does it kind of work? So the basics behind this is that the higher the probability of price staying inside of that range, the lower the payout. And the lower the probability of price staying inside of that range, the higher the payout. So again, here we can see a high probability of around 56%. Our payout in terms of our profits is about, 94%, 84%, 90%. If I change probability to the lower end, (25% probability that price will remain inside of that range), now I'm getting much higher risk reward ratios, another higher percentage. And that's what makes this strategy attractive to more advanced traders. They feel that they can really tune in on a range of price and then really narrow that range of price, so they can get a much higher profitability. So probability will also be influenced by how wide or narrow we cast our net of our price. So let's go back to our high probability here and see if I can give you a good example of that. All right, so for instance, here we're looking at Apple, and current price is right around $1.51. So let's see what we have. So I looked at this earlier, and of course everything changes. Maybe I'll do Tesla here. Let's see. Yeah, Tesla might be a better example. Tesla's trading around $772. So look down here. We got Tesla here. We have a body strike of around $765. And then our wings looks like it's about, what is that, $85 in width of our wings. So, very wide range of price. We're casting a very wide net. If I look at a lower probability event, let's say a narrower net, let's see what pops up. So here we have a Tesla trade where our net is only $45, half of what we saw in that other example, which was $85. So a smaller range, a smaller net, a higher probability that price might be outside of that range, a lower probability that price will remain in that range, and that gives us a higher profitability or max profit. So just like we think about, as I was talking with Gene in the beginning, capturing a butterfly, the bigger the net increases the chance of catching a butterfly, right? Hence the wider our spread. So a higher success, the bigger the net, the lower the return. That's kind of how you want to work that out. So max profit and max profit percentage is directly related to our probability, but it also is related to our body selection. Again, either I'm going to look for a body that is at the money, right near current price, or if I have a bias, I could look for a body that is slightly in the money or slightly out of the money. So this influenced by these two variables, the width of the wings, our net of probability, and that shift, that kind of delta shift of a bullish or bearish bias will also help with that profitability. So again, here we're looking at Apple, and currently Apple's trading around 151.30, and here we see a net that's about looks like about was that $7.50, and we're really close to current price. But if I have a little bit of a bias to one way or another, I could say, let's say I thought Apple was going to go down in price and then stay there, I'm going to get maybe a little bit greater profitability if I choose a body strike that's a little bit away from current price. All right. Break even, BE plus, BE minus, that's our break even values. That's our cost of our trade minus our outer and upper and lower strike value. So the BE plus would be our upper minus the cost of the trade, and our BE minus, that would be our lower break even, would be our lower strike plus the cost of the trade. So in this example here, our upper strike is 160, our cost is $4.12. So that gives us a break-even value of 155.88. And maximum loss is, just like I said, our net debit, or the cost of this particular trade. So there are some other features that we can look at, let this line up, that are part of the design of this page. Besides the main view that we just kind of walked through, you can also find dividends and earnings information. Now, what's important here is, again, these two events will have an adverse effect on this strategy, so we kind of want to avoid them. We'll talk about earnings to help maybe set up this strategy, but dividends we definitely want to avoid. So just because it says NA does not mean that this company doesn't have dividends. It probably does have dividends. But what could be happening is that they haven't declared that dividend date. So it's important to understand that there might still be a dividend, or still might need to do our due diligence. But if you see an NA, that usually means that they haven't declared that dividend date before our expiration date. And since this strategy is going to be a very short time frame, then that's what we kind of want to look for. What we want to make sure is that our dividend date is outside of our expiration date, or that we don't have a dividend date inside of our expiration date. That would be problematic for our strategy. Okay. Now, the other thing we have here is what is called the filter view. There is some pertinent information in here as well. In the filter view, we can look at days to expiration, how many days until this option expires. What type of option is it? Is it a weekly or is it a monthly? And then again, some more information in terms of volume and open interest of our different legs. But some of the things that we could do, maybe you might want to add some filters, maybe some other criteria or things that you might want to be interested in. So we could go to set filters. And one of the ones that I think might be a little bit more interesting to watch or maybe add to what would be our options overview. And we're going to talk about implied volatility. We're going to talk about applied volatility rank and percentile. But maybe I want to just add implied volatility to my filter. And then when I look at set results or see results under the view, it's going to show me the implied volatility. So if I add any inputs or filters to this page, that's where I'm going to find that information. Okay. And again, you could be looking at fundamental information, or you could be looking at price information, whatever, other information that you would be concerning to you. All right. So let's do this. Let's go back to the main view. And let's add that's popping up. And let's look at the higher probability events. Let's see what we do in here. So one of the other things we can start to think about in terms of, let's say I've come to this page and I'm familiar with some of these stocks that are popping up. Now I'm looking at just the few ones here in the top high probability events. We got Apple, Nvidia, Tesla, Facebook. Now Tesla, would Tesla be a good stock for this strategy? A stock that is not going to be moving around? Probably not. But maybe Apple might be. Apple's been kind of stuck in a range. It has been under pressure of recent. But let's say I like Apple I think that Apple might be a good candidate. Now, it could be based on my idea of what price is going to do. And we could look at, let's say, support and resistance or areas of supply and demand that some of you folks would be familiar with. And again, I was looking at this morning. Apple was trading closer to 155. And I was kind of thinking, it looks like Apple has kind of been in a range here for a while. But in the big picture, it looks like there is some support down here around 145 and certainly some resistance around 165. So I was thinking maybe Apple somewhere in that range. So what I could do is I can come to Apple over here, and under the links here, I'm going to go and look at more examples. And now what this does is it takes the information from our page, and now it's just looking at the Apple examples. And again, we have different butterfly strategies. We're looking at the long put. And notice now we see all the long put strategies that are related to Apple. Again, remember one of the things I said is if I can pick a strike price that has a bias, for instance, this one, it's saying if I set that body at 123, right, a very low probability, almost zero probability, but look at that reward that I would get. So that's why this strategy is very enticing to a lot of professional traders. But, I'm not thinking about price getting down to 123. I'm thinking about price staying in a range somewhere between that 145 and 165. So I'll come back into the screener here, go back to my filters. And what I'm going to do now is I'm just going to type in the word strike. And we know that the way this is set up, that the middle strike is our body. So what we're going to do is we're going to pick our middle strike. We're going to add it. And we want to pick a value that we believe that the middle strike or the body of price is going to stay close to. So I'm going to say, let's say just for argument's sake right now, we'll set somewhere between 152 and 155. That's kind of where I was looking at this morning. And I'm saying, hey, the body, I'm going to try to predicted the body's going to land somewhere around there. And now it's really kind of narrowed this down for me, right? So again, what did I say? Well, there was kind of that range of price. And so here we got 155. We said the lower end of our support was around 145, and the higher end of our support or the resistance was 165. So I'm casting a $10 wing net, right? And right now, because Apple price is below 155, I have a slightly bullish bias. But the cost of the trade would cost me about $4.51, and I could make around $5.49, right? And that would give me a profit of 121%. Again, remember we talked about if we lowered that net, right? We made that net a lot smaller. Again, here we have a 155 middle strike, body strike, same strike that we just looked at. But now we're casting a much smaller net, only of $2.50, right? We're a very smaller net of probability, right? What is our probability? Chances goes down because price probably is not going to stay in there. But if we're correct, look at our profitability. In this case, actually, it would be a losing trade, but that is probably because it's cost more at this moment in time. But that's a good example of how we can look at the size of our net. All right. So that's kind of just how you can do the filter system to use to pick a better strike combination in terms of your bodies and your wings. But the other thing I also said to you guys is that one of the keys to success is a drop in volatility. So one of the more common events that it happens with all stocks is something referred to as the post-earnings volatility crush. Now there's this lead up to earnings that implied volatility will start to rise, and then after the earnings comes out, right after the earnings comes out, you usually see implied volatility fall. That's what is called that crush. So in preparation for today's session, what I did was about a week ago when I was putting this together, I went to our calendar of earnings, and I wanted to look during the last week of April to see what stocks were having earnings. And on Tuesday, April 26th, one of the stocks that I'm a little bit more familiar with, one that I trade, Visa. It also happens to be one that is in our 22 stocks for 22. Now, currently, I do not have a position in this stock, but it's one that I'm a little bit more familiar with. So let's go to the videotapes as they say, and I'm going to just blow up this chart a little bit. Bear with me. So let's go back in time here. And again, I'm just kind of looking at this in the big picture. You know, Visa's been kind of stuck in this range for a while. You know, the upper end of the range looks like around 230, the lower end of the range, you know, about 195. And then here, this red candle here, that is April 26th. That was the day of our earnings, and earnings came out at the end of the day after the close. Now, price was falling. So again, volatility was probably rising, implied volatility was rising. And then after the earnings came out, well, then what did Visa do? Well, Visa price shot up. It was good earnings for them. Price went back up. And then the next day, price went up again, and it bumped up against this resistance. It came in here and filled this gap. And then the next day, now this is 3 days post earnings, it fell back into kind of the middle of that range. And that's what I was looking at. I was like, hey, you know, maybe now we've got the little bit of the juice that came from the earnings, and now we're going to be stuck back in this range. And then I'm looking at that support and resistance. So again, on the upper end here, the blue line 225 is kind of an area of resistance. The lower end, $200 is kind of, the bottom of where we had bounced off of prior to the earnings. So I was saying, hey, maybe price will stay in this range for the next few days, maybe up until expiration. And then for the next 3 days, that's exactly what it did. Now let's go back to our slides, and what I want to show you is, so this is a snapshot of the price action at the end of the day on that day after price, the third day after the earnings, where I'm kind of saying, hey, maybe now price is going to be stuck in that range. And so this is for our Visa. Remember, I showed you that you can select just for one particular stock. And there's our 200 lower strike price. There's our 1250 middle body strike price. And there's our 225 upper strike price. And so the cost of this trade was around $4.65. And potential profit on this one was 168%, around $7.85. And this was a monthly expiration. Now, let's talk about probability again here. So, do I want a high probability or do I want a low probability? So again, every trade is going to be different. And so just from my personal perspective, I kind of find that when you look at that balance between the risk reward max profit and the probability of the size of your net, I find that in that 35% probability is really you get the best blend between profit and the size of the net. In this case, we're casting a net of, $12.50. So this is a screenshot of the options overview history for Visa. And this is again for that date, that Friday, April 29th. But let's see what happened just prior to that. So you can see here's April 19th, 21st, 22nd, 25th, and then here's our earnings date, April 26th. Notice how remember our price was falling, but also our implied volatility was rising. And on the day of that earnings, we can see that our implied volatility rank and percentile was in the 99 percentile, right? That's telling us that our implied volatility was the highest it's been for this particular stock for the last year. And that's what we usually typically see in all stocks leading up to earnings date. But then after the earnings report is released at the end of the day on the 26th, for in the case of Visa, notice that our implied volatility fell. That's that volatility crush. And this is where this strategy can be implied or employed. It's what we want to see, that implied volatility fall. And you can see that implied volatility for the next couple of days did fall. Our rank and our percentile did fall. And the date that I put the trade on, or hypothetically put the trade on, was on the 29th. And that was this date here. Now, the next 3 days, price kind of gravitated around my body. So I was feeling good about myself, about the trade. As a matter of fact, at this point, when I was watching the trade, it was up about $1.75 in profit, maybe about $2 on an intraday basis at one point. So the trade was working. Now, with every trade we do, every trade we need a plan, and that plan is going to tell us when we're going to exit the trade. Now, obviously, we want to exit trades with profits, but we also have to have a plan to decide when we want to exit when we know we're wrong. So in this particular strategy, one of the things we might want to think about is exiting when price starts to move away from our body and getting closer to our wings. And notice what Visa did. Next day it fell, and then the following day It fell outside of this black line, which represents my lower break-even price. And so in my trade plan, when I set this strategy up, I say if price closes below my break-even, then I'm probably wrong. I'm going to be out of this trade. And just, follow through on this trade to show you what happened. And that would have been a good decision because the next day, Visa not only fell lower, gapped lower. Again, gap risks we see a lot more in common with stocks, but it also gapped below my outer leg. And so at that point, I probably would have taken a substantial loss. All right. And then you can see that currently it's still outside of our leg. So let's go back in time. And here's that Visa, again, that trade, but this is the day that price closed below my break even. Now, my lower break even at this point was our 200 strike plus the cost of the trade, $4.65 or $2.65 was our break even value. And you can see the close of the day for Visa was 202. So these are closing prices. So we got to be realistic. But let's see what happened. Now, notice that our implied volatility was up just a bit. Remember, we said that we had a high implied volatility on the earnings date, but we did get that drop off. But we did see a little bit of a bump in implied volatility as price was moving again. And I did say to you that sometimes a rise in implied volatility, especially when we're wrong in our analysis, this is exactly what has happened here, that might help us in terms of limiting our losses. So let's look at this trade down here on the bottom. Our 225 put that we were long is now worth somewhere between going into the close, somewhere between $2.25 and $22.25 and $24.15. So let's kind of middle of the road that. Let's say that's around $23.25. The last trade was $24, but that was probably outside of the range. Our $200 put that we were long, our bid ask is $455, $485. Again, if I'm middle of the road, it looks like around $470. So I'm getting $23.25 plus $4.75. So that's around $28 I'm going to get back from selling out those long puts. Now I have to cover my short puts. Here's my $12.50 short puts. That's our body. Now let's be more realistic on this one. We're going to buy the ask, right? That's how we're going to get out. So I'm going to have to buy two $12.50 puts at a price of around $12. So 2 times 12 is $24. So we're taking in $28. We got to buy back for $24. Net difference is $4. The original trade was $4.65, right? $4.65. So our net loss on this trade, even though the strategy didn't work, but implied volatility did bump up a bit, our net loss on this one only would have been about, a little bit less than $1, 65 cents or so. So having a plan, executing that plan, and exiting a trade when things are not going our way will save us money. Now let's look at what's going on today. We are outside of our wing. We are outside of current price. So if we go back to current options prices today, I need to add a couple strikes here. Looks like our 22.25 put is worth about, let's say $28, give or take. Our $200 put is worth around looks like what, $4.50. So $28 plus 48 for $4.50. That's $32.50. And those $12.50, right, is $16, $32. So this strategy has very little value left in it if we held on to this trade all the way to today. Again, why is that? Well, that's because we're not at maximum loss, because we're not at expiration, so there is still some value in some of these trades, but that's because we are outside. We have one of those events has occurred. We are outside of that long put lower leg. Okay, so that's basically the general idea about long butterfly strategy. Again, I want to kind of just say it's more for the advanced trader, and it's one of the ones more difficult ones to trade. So at this point, what I want to do is I'm going to pause here and answer some of your questions. I see a couple of questions popping up. Anything in particular you want to add, Jean?
Well, yes, I'd like for you to take another moment to navigate and show people how you got back and forth, because there were some questions on that. Do me a favor, start back on the, well, no, you know what? You're on the Visa chart. So a number of people were getting confused when, you know, how do you get to see additional options for the symbol that you're looking at. Down the left side of the page under under butterfly spreads, we're talking about, right, go ahead and click on that link if you could, John. So there's 4 butterfly spreads that we have, and today we're talking about the long put. So John was in this page at one point, I believe on the Apple stock. So this is one way you can go and you can select your expiration. John, go ahead and select, get out of the weekly and maybe choose a monthly expiration. And let me demonstrate for you one way for you, like if you know that you're looking at Visa, if you know you're looking at this expiration date, there's a screen icon on this page that will take you directly into the long put butterfly screener and show you only the results for the symbol that you selected and for the expiration date. So like if you go over to the set filters page, John, if you can select set filters, you'll see that it's really particular to that one symbol Visa for that expiration date. Okay, go back to see results, John, if you could. And this is where a few other people got confused. When you are looking at the long put butterfly screener, if you open up the links column, John demonstrated the more examples. This is just another backward way, okay, go ahead and click that, of going back to that symbol's butterfly spreads page so you can look at all of the different possibilities that are out there. So just...
And again, that's where we can screen from this point. We can screen by clicking very selective strike prices. Now, I recommend that you start with the body, but some of you might actually know where you want, how wide you want to make your wings. So you can come back in here and screen based on the strikes of your wings. And that would be, right, our strike of our
exactly
leg 1 or leg 3, if you know exactly what you want. And again, you can really fine tune this. If you know exactly what you're looking for, you know your wings and your body, then you can really refine this down.
Right. So the point that I want everyone to come away with is that there are multiple ways for you to look for the specific options play that you'd like. And if you do have any questions on how to navigate back and forth the way that John was just showing you, please email support@barchart.com. They'll be happy to help you.
Yeah, we have some great options guys there, so they would definitely help you out with that. So I see a lot of questions. A couple questions here is about iron condors and iron butterflies. We're going to look at those at some time in the future. There's a question about something called a broken wing. So there are some advanced parts of this strategy where, let's say, you have more of a downside bias, so maybe you would widen your wing to the downside and shorten your wing on the other side. So in other words, you kind of like your wing is flapping, in other words, a broken wing. So we're not going to go that deep into this one. So the question I see here, one Gina wrote, is there a percent profit or a dollar profit you want to sort or evaluate by? So Gina, again, it really depends on the trader, the stock, right? If a stock has a lot of price volatility, a higher probability price is going to move around. You're going to get a greater profit potential, depending on how wide you set your wings or how narrow you set your wings. So it really depends on you as a trader in terms of your risk tolerance and what you are looking for. Again, if I'm looking at an index or an ETF, I'm probably going to be looking at a lower probability of price movement, which means it's going to be, higher probability that price is going to stay in a range, lower price volatility, which means that I'm going to get a lower profit. So again, I want to get paid for predicting where the butterflies are going to land. So, can I put a number on that? No, I can't, because there's so many other variables I have to look at. But, in options, if you can get a risk reward ratio of, let's say, 1.5 or 2 to 2.5, that's probably a good place to start looking for those ones. And the one example I did with the Visa was just a little bit better than 1.5. Remember, we're not taking this trade all the way through expiration. So good question, Gina, there. I wish I could really give you a defined answer. Brian asked, do we need to worry about dividends on a buy or a sell? And again, Brian, I think we went through that. The ex-dividend is definitely something that we need to be aware of. All right. So let's see. Ali is asking, we see the Greeks for each option policy choose the option trade that's best suited for us. Again, Ali, there's really three of the Greeks we really kind of want to be aware of. Do I have a delta bias? In other words, do I believe price is going to stay exactly where it is at current price, or do I think it's going to drift lower or drift higher? That would be the one. The volatility, that is important to us, right? The Vega, right? I want to see, a decreasing volatility, a falling Vega, and then also theta. We want to see a rising theta. So again, if you wanted to look at some kind of comparison, probably want to see a greater theta versus a lower Vega, which would be a good start in that one, right? So Gina asks again, the outer wings is the max loss. Yes, exactly. You have to have two events occur. Price has to be outside of your outer wings and at expiration. Would you get assigned? Well, in that case, if let's say the lower, let's pretend that price has gone below our lowest put, then there would be a combination of 4 assignments, wouldn't there, right? We would exercise our right. We bought the higher put and we bought the lower put. We would exercise those, and then we would be assigned the ones that we short. So it would be a net wash on the total position, and it would just be the maximum loss at that point. Okay? All right. Some good questions there. Hope you guys enjoyed that. Let's look at some takeaways. Again, let's kind of concentrate on those candidates we believe volatility could be falling in conjunction with a quick time decay. That was kind of what Gina was asking. And again, post-earning volatility crush is one of those scenarios that is favorable to this particular option strategy. Again, let's look at those implied volatilities. We want to see a high implied volatility. That's going to make sure that we're going to get some good premium prices. And then we want to see that implied volatility fall. So maybe as we get close to, let's say, our historical implied volatility, that could be part of our exit strategy, right? Let's say I've gotten away from the historical, and now over the next 5 days, I put the trade on. Next over the next 5 days, we get that crush, and now we return to historical volatility. Well, then maybe that might be a time to take the trade off, where I can take a little bit of money off the table. Using our charts, our technical supports, and resistance. I showed you an example just looking at the charts themselves, but you could use other things like, for instance, if you're very, very short dated, let's say you're only trading, I know a lot of the options traders will do these on weeklies with 1 or 2 days before expiration. So you could look at a technical analysis, something called the average true range. And I see a lot of traders will do is they'll set those outer wings outside of the average true range. And that would really kind of narrow that range down. And then, because maximum profit can only be achieved if your butterfly lands exactly on your body at expiration, two very difficult things to happen, right, in terms of chance. So let's not be greedy, all right? Let's set these trades up and let's look to cash out if we can get, let's say, 50% of our max profit, or we're up a certain percentage. Again, each trader is going to be different. In that case of that Visa trade, where I put out $4.65 and my maximum profit was around $7.80, I believe it was. And I said to you, well, 3 days into that trade, that trade was worth about $6.50. It went up about $2. So in 3 days, what did I make, right? So I made about 50% return on my money. That would have been a good time, in hindsight, to close that trade. Again, some traders, like I said, they make a living doing this type of strategy with only a couple days to expiration, and I totally respect that. I understand that, and I think I tip my hat to those traders. But for us, some of us who are just kind of just learning how to trade options or looking at different types of strategies, if I have 20 days to expiration or 10 days to expiration, and I put this trade on, and for 3 days my butterfly is sitting on my body, and I'm up 50%, you know what? I'm not going to take that chance. I'm going to take the money off the table and put that money to work at something else. All right. So I hope you guys enjoyed today's session. I appreciate all you being here today. What do we need to talk about, Gene? I guess we need to talk about next week's section, but we don't have that up yet, do we, Gene?
No, we do not. What I do want to talk about is our bar chart premier subscription. The screener that John was showing you today is part of a bar chart premier subscription, and we do offer a free 30-day trial for you to try it out, so you can look for these special options. And if you haven't tried Premier, I really suggest that you give it a go. And we will probably have the next session available sometime in the next few days up in this website. If you want to be the first to know about when we post webinars, John's showing you right there on the screen, you can join our webinar notification email list. We will let you know via email as soon as that thing hits the website. And you can also view all of our past videos on our YouTube channel. And you can subscribe to our YouTube channel to get notified of when new things are posted there as well.
Okay, Gene, thanks so much for making another great session. Folks, again, thank you so much for supporting us here at Bar Chart. I want to wish you all the best of health. Stay safe out there, and the good of all trading.